We just dodged a bullet. The federal government has implemented, as of yesterday, that they will make it whole for all depositors at SVB. There's another bank at New York called Signature Bank that has also been depositors have been protected, and there may actually be many more that may be unfolding as the week goes on, because this leads us to different questions. What will happen next? What does this then mean for the housing market here in the Bay Area? So here is a little bit of what has happened related to the federal, what they have done. You can see they have made an announcement that they are basically effectively creating this program in place to ensure that there's going to be liquidity in the system for depositors. And they're going to basically create, in effect, unlimited funding for these banks. And basically, it's going to be the regional banks, but they're going to provide unlimited funding for them so that there shouldn't be theoretically a run for the money. Now, this leads us to a lot of other question marks, though, right? Why would people choose to put their money in a regional bank to begin with? Let's think about that. They choose to have their money in a regional bank to begin with because there may be good relationships. Some may offer different types of discounts for being a partner or for having an established relationship that some of these bigger banks would not do. But if now they're going to be under a tighter lens, I don't think you're going to be able to get as favorable options when it comes to working with them. What does that mean? I don't think you're going to get as strong of lending options when it comes to businesses, like business loans. I don't think you're going to get strong options when it comes to residential loans. I don't think you're going to get too many perks anymore, right? And that's how Silicon Valley Bank and some other players here were able to be so competitive with the big banks or even mortgage brokers to help people. But if these are now either no longer going to be existing or it's going to be a much tighter to begin with, and that's going to lead us to a lot of challenges for those regional banks. That's why you have saw today that First Republic Bank has declined 60% of their market cap in one day. Because best case happened, which is we just got best case happened in the time that we're at, which is it's not going to continue to be as widespread, but it will continue spreading. Because people have to realize and understand, why should I keep my money at this bank? The interest rate at a lot of these banks are incredibly low anyways. It's unless you're able to have different type of relationship discounts somehow, there's not much reason to have the money at these banks. You may as well just go for safety, and then you go for the big banks. And that's why the big banks have gotten a ton of money in a very short amount of time. And so those big banks just get stronger. So what does this then mean, though, for individuals that may be on the fence of buying and selling, right? How does that impact the Bay Area market? Now, for the most parts, the lenders that were doing these kind of loans for individuals were not that competitive, to be fair, on the Bay Area price points as a whole, because the Bay Area has more of these jumbo price points, which is usually above over $1.1 million considered jumbo. The big banks have always been stronger there, and they take turns in terms of deciding and figuring out who's going to be the strongest or not, because they can use their huge asset books to be able to borrow against it, and then they can also sell you these other investment products to make money off of you. That's why the big loans, the bigger it is, the more advantageous it is when it comes to options. Now, on the other hand, these smaller banks had actually been done pretty good historically on those that are conforming loans or those under 1.1, because they have a few options that they can use, but also that's where they felt they can be more competitive because they have these other offerings and they want to be able to grow with individuals. But now that that's gone, then that kind of creates this, I would say it was an opportunity for some potentially, just depending on where they were at. But now that product and that time is gone. So then you go with like, okay, now you have to basically go with mortgage brokers. Now, if you look at it, like the big banks were not very strong for these under $1.1 million types of homes and loans. They just didn't want to be competitive in that. That's why the conforming ones weren't that good. How do they choose not to be good? They just choose to increase their rates a lot so that you won't even come to go use them. So it seems like then there's a kind of a little bit of a playing of the guard. So mortgage brokers will be even stronger in that capacity. Regional banks continue to get hurt and will continue to lose market share as they lose more deposits, as they have to be more tightened in terms of guidelines, as they cannot maybe choose to buy these longer term holds of like 10-year treasury yields or mortgage-backed securities. They're not going to be able to do and be as competitive. And so they're going to keep shrinking. I don't know when it reverses. There's going to be a certain amount of people that are diehards, but if those options that they have are not as good as before, why go there? Why not you go to an online bank? Why not you go to the big banks? Like the big banks have a little bit more perks that these smaller ones have. So it's a big challenge overall for these smaller banks to have to deal with and to have to like figure out like how does their business model work. But without a doubt, their opportunity is going to be significantly less. And that's why you saw the regional banks index has dropped tremendously. I think now it's like 15-20% within a day. And some banks like First Republic got hit a whole lot harder. Now, there are positives of this. Whenever you see down things that are down, it does not mean everybody loses, right? There's always two sides of the coin. So what's the other side of the coin? Let's take a look. The other side of the coin is there are evidently a lot of people that are not impacted by this at all. I mean, imagine if you're in healthcare. Imagine if you were in big tech. Big tech was not involved with this. They were already looking for homes. They are still looking for homes. And so now they have the ability to buy with less competition because there's going to be less people out there looking. At the same time, you can see mortgage rates tumbled. They have declined by 0.5% in a matter of less than a week. So that's been good news then for those, right? So you can see it came down from 7.05 last Wednesday. It was at 6.76 on Friday, and today is now at 6.57. So there are always things on the other end, and these are always opportunities that come in. That's how things work. If you have more layoffs, the rates are likely to decline because that means that all those increases have shown to work. So this is like how it is. So for those that are on the fence, you got to figure out on your end what is important to you. Like, why are you looking for a home to begin with? How long do you plan to look at a home? How long do you plan to be at a home? And how is that relative to how much you're spending a month or a year in terms of rent? From there, make the decision. Do you want to start actively looking or not? And if so, you can see there's going to be less buyers in the market. We are in the spring season, so you're going to see more homes come on the market relative to the last 2 months. And then you can see some relief. Hopefully, this continues forward on the mortgage side. So those that are still in the game, they have a better advantage. And if they have bought a home at a higher interest rate, they can refinance and lock in these lower rates as they come. So at the end of the day, there's always pros and cons in all situations, all markets. We're obviously going to continue to see how this plays out. My guess is that the regional players, as a summary, regional players are going to keep getting impacted. The question is, when is the bottom? Because they've already got a huge hit from a stock perspective. We hopefully will continue to see rates decline. Now, I mean, you can see it dropped 0.5% in less than a week. So we're going to see that. We're going to see probably less buyers in the market, which means there's some more opportunities for you trying to get into the different cities and neighborhoods you want to get into. And then the big banks are able to get a lot more deposits, so they may theoretically be stronger. So we'll see how that plays out. If you have any questions, if you want to buy, sell, or invest in the Bay Area or anywhere in the country, my team would love to help. You can reach out to our contact details below or call or text 408-547-4590. See you in the next one. Bye now.